Why is it that buy-to-let property investors are choosing to no longer buy property in their personal names? They are now choosing to buy property in company names instead. In this video, I want to explain exactly why they're doing that. If you're watching my videos for the first time, my name is Saj Hussain, and on this channel I share with you my 15 years of property investing experience to ultimately help you get further faster in your own property investing journey. Many property investors and buy-to-let investors over many years and decades have chosen to buy property in their personal name. However, recently all that has begun to change. Why is that change happening? Well, what's happening now is many of them are choosing to buy in a company. Well, if you think about it for a moment, if you're purchasing a property, rather than purchasing in your own name, you're choosing to buy in a company, well, technically speaking, you don't actually own that property, the company does. You might, however, own all the shares to the company, but it's a separate legal entity. The reason this change has started to happen is because of taxation. There's been changes in the way we are taxed as buy-to-let investors, and effectively it's now less viable, almost not viable, to have property in your personal name, especially if you've got mortgages on those property, and this is why people are buying them in company names. So in April 2017, Section 24, as it's known as, was effectively rolled out, and what that meant was that we were no longer able to offset all of our mortgage interest as a cost. So if you think about this for a moment in the context of any other business, if you're purchasing items to resell those items, you've got costs that you incur in that process, and your profit is treated as what you sell the item for minus all the costs that you've incurred, your purchase cost plus other costs, etc. That's how profit is normally calculated in business. And interest is a cost within the context of buy-to-let property investing. However, the government in their infinite wisdom have chosen to no longer allow us to do that. So this was gradually happened over 4 years. In April 17, only 75% of the interest was allowed to be offset. Then in April 18, that changed to 50%, then down to 25% in April 19, down to 0 in April 20. So now, where we are at the moment, we're no longer able to offset any interest in terms of our cost when we hold property in our personal name. So why is the rush to move to limited companies? Why is limited companies different? We are still able to offset the mortgage interest within a limited company, which we're no longer able to do in our personal name. However, buying property through limited companies comes with a whole host of its own challenges as well. So for instance, when you're purchasing property in a limited company, as I mentioned earlier on, it's a separate legal entity. So to extract the profit that you're making from that, it's essentially the company that's taking that profit out, but who's going to take it? So you, say, as the owner of all the shares within that company, if you're taking that profit out, that's probably in the way of dividends, you've got to pay tax on those dividends. But the company will also pay tax in terms of corporation tax on the profits that it makes within the company as well. So effectively, you're getting taxed twice. A double whammy. So you've got to look at how you are going to make this overall efficient for you from a tax point of view, because there's lots of different taxes to consider. It's not just simply a case of offsetting your mortgage interest within the transaction. For many people that are lower taxpayers that are holding a couple of properties in their personal name, it's probably not going to be worth going through the process of moving these into a limited company or buying properties in a limited company. It's generally speaking, when you get into the higher tax bracket, you're earning 50,000 a year plus, and you're paying 40% tax on there, that's where it starts becoming more efficient to hold it within a company structure. Other factors to think about is, as the company is a separate legal entity, your accounting costs will be separate as well. So not only have you got your personal tax affairs to deal with by your accountant, but now your accountant's also dealing with an additional company and all the things that come with managing and running a company as well, and the compliance on that side. So you'll have additional costs occurred there in terms of accountancy fees. I remember about 10 years ago when we were initially looking at buy-to-lets and buying property in companies, some of the challenges that we had at the time is very few mortgage lenders were actually available that provide products that would suit buying properties through company names, because the vast majority of people were buying property in their personal names. Roll the clock forward to right now, when we look at what's available in the market. Now there's many more mortgage products available in the marketplace than there were before for limited companies. So it's much easier now to be able to get a mortgage within a company when you buy a buy-to-let property. Even if it's a brand new company that you've just set up and it's the first property you're purchasing, there are mortgage products available to be able to purchase that property. The thing to bear in mind with buy-to-let mortgages in companies is that there's more paperwork involved. As I mentioned earlier, it's a separate legal entity, so you'll have to get additional legal advice there as well, and often the interest rates are not quite as attractive compared to personal buying properties in your personal name, although the rates are going to get quite close, but they're still not quite the same, and you're generally paying a little bit more interest when you're buying through a company. That's all well and good when you're doing new property purchases. However, what do you do with that portfolio that's already in your personal name? How is it that you can make that more tax efficient? Well, some people have chosen to go through the process that allows them to effectively incorporate that and turn it into a limited company. But it's not a one-step process and it's not very straightforward. Essentially, the process is that you turn it into a limited liability partnership at LLP first, and from there you transition it into a limited company. And that way you avoid paying the stamp duty and also the capital gains tax that you will incur if you were normally to sell those properties into a new limited company. Because you can't simply transfer properties that you own straight into a limited company. Because they're two separate legal entities, you're effectively selling them as you as the seller to the company as the buyer, and that's where you start incurring the taxation around capital gains and also stamp duty as a purchase. What I'm sharing with you is property investing guidance from an educational perspective. However, it's really important that you are taking professional advice from an accountant or a tax advisor that's going to help you structure your circumstances, your situation in the best possible way. And when you do that, it's also important to take advice from a finance advisor who's going to help you refinance or finance purchases, so that not only the structure that you've set up works from a tax point of view, but also the structure works from a borrowing point of view when it comes to approaching lenders to take those mortgages. Because there's some really clever structures you can do, you can set up to become really tax efficient, but most of the mainstream lenders don't like those kind of setups, and it becomes very difficult when you need to borrow money. Sometimes you'll see group structures that people will use. So for example, you've got a company that's set up here that owns property. You might have another company that's set up here, which is a trading company, for example, one that buys, develops and sells property. And you might even have another one here, which is like, for example, a services company, say for example, a property management company. And all three of those companies can be owned by a parent company to create a group structure, and that can also be a way to make your overall property business, depending on what you're doing and the size of it and what it is that you're trying to build, to make it very tax efficient. If you've enjoyed this video around buy-to-let property investing and Section 24 tax and how to make it more tax efficient, then you're really going to like this video that we've lined up over here for you, which is buy-to-let mortgages. But just before you go and watch that video, make sure you click on my face just down here to subscribe to the channel, and I look forward to seeing you on this video over here.